A 12% spike in net revenues has the broader market cheering for Coca-Cola, but skeptics are calling it a mere mirage. With 6 extra shipping days skewing the numbers, is this surge justified? Proper stock market analysis requires looking past the surface. When you examine the 3% organic volume growth, the calendar illusion shatters instantly. Organic volume growth measures the actual amount of product sold, stripping out price hikes and currency changes. At first glance, those 6 extra days artificially inflate sales. But that 3% organic volume growth figure proves consumer demand remains exceptionally robust. The real implication is that momentum backed by fundamental consumption sustains premium valuations. This is something you can easily check for yourself. To grasp this underlying strength, we must look at how they manage costs. Operating margins expanded to a massive 35% this quarter. Operating margin is the percentage of revenue left over after paying variable costs of production, showing sheer enterprise efficiency. How did profitability defy gravity while input costs spiked by roughly 8%? The mainstream media assumes margin compression is inevitable, but management brilliantly achieved this 35% operating margin by deploying a masterful price to packaging mix. They effortlessly passed costs directly to consumers, pushing prices up by 13% across various segments. For your investing strategy, undeniable pricing power serves as the ultimate structural shield against inflation. This brings us to the elephant in the room regarding profitability. Reported earnings per share unexpectedly skyrocketed by an impressive 18%. Earnings per share measures a company's net income divided by its outstanding shares, acting as a core profitability gauge. But if we dig deeper using fundamental analysis, a favorable foreign exchange tailwind provided a massive 6-point artificial boost to that exact headline figure. Financial critics quickly label this sudden profitability spike as macroeconomic hype. Yet, even stripping away that 6-point foreign exchange boost, comparable currency-neutral earnings per share delivered impressive double-digit growth of 12%. As an investor practicing true value investing, you must meticulously isolate the core operational engine from external currency noise. You cannot protect global market share purely on aggressive pricing. You need a product aligned with shifting preferences. Coca-Cola Zero Sugar confidently delivered a staggering 13% volume growth this quarter. Is this rapid expansion just a passing fad? Most analysts foolishly treat zero sugar lines as temporary niche alternatives. But that specific 13% volume growth figure proves it is single-handedly carrying the flagship, sparkling beverage category forward. What does this mean for your portfolio? Continuous innovation fundamentally shields equity holdings from changing consumption habits, securing long-term shareholder value. Strong fundamental analysis always factors in adaptation, and a 13% volume growth rate proves they are adapting beautifully to consumer demands. However, no corporate empire is perfectly immune to shifting macroeconomic realities. This brings us to the Asia-Pacific region, where volume growth climbed by a seemingly impressive 5%. But the crucially vital price-to-mix metric plummeted by 6% in that exact same market. The price-to-mix metric reflects how much consumers are willing to pay for specific combinations of products and packaging. This severe pricing pressure disastrously dragged regional operating income down by a painful 14%. Witnessing that 5% rising volume growth seems like an automatic victory, but that alarming 14% operating income drop mathematically reveals the company deployed affordability initiatives just to maintain relevance. This dynamic serves as a crucial reality check on global spending power, critically shaping your future investing strategy. How do they counterbalance this regional margin compression? The answer lies in consumer psychology and strategic revenue management, fueled by generating $1.8 billion in free cash flow. Free cash flow is the cash remaining after paying for operating expenses and capital expenditures, giving immense room to innovate. This $1.8 billion provides structural flexibility to push premium packaging worldwide. By rolling out mini cans in North America, they quietly reduce package sizes while elevating overall profitability by nearly 10% on specific items. Meanwhile, Europe, Middle East and Africa organic revenues faced a frustrating 3-point foreign exchange headwind. Despite this 3-point foreign exchange headwind, aggressive local marketing drove tangible weekly drinker growth. This proves sustained stock performance is driven by ruthless operational ingenuity, a core tenet of modern value investing. This operational mastery leads to the ultimate question of corporate guidance. Management explicitly maintained conservative organic revenue growth guidance of 4 to 5% for the full year. Simultaneously, they confidently updated comparable earnings per share guidance to a solid 8 to 9%. Comparable earnings per share adjusts basic profit numbers to remove one-time events, giving a clearer picture of ongoing operations. Why offer cautious top-line projections of 4 to 5% while signaling strong bottom-line confidence? Institutional investors react positively because that 8 to 9% comparable earnings per share guidance balances upcoming divestiture headwinds with extreme efficiency. Sound stock market analysis tells us that clear structural visibility and consistent cash flows violently beat speculative growth narratives. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything. Into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.